uncertainties that typically face investors. 2022 was no different. At the start of the year, the focus was mainly about whether or not Africa would be successful in its vaccine deployment rollout. But in a couple of weeks, the focus turns to geopolitical tensions, and that's pervaded the atmosphere, if you like, in terms of how the world was working, the economies across the world were working, and no doubt Nigeria had its fair share of its impact. So you're all welcome to today's event, and we look forward to getting a lot of very valuable insights from our speakers. Just to run down what is coming up very shortly, I'll be welcoming the Group Managing Director of Meristem Securities, Mr. Wole Abegunde, to deliver some welcome address to provide some context for today's event. And then we'll get right into it with a presentation on the global and domestic macroeconomy. Then we'll focus on the equities markets, and then we'll drill down to the fixed income markets and the commodities markets. And no doubt we would also focus on the investment strategy and provide some ideas there. And we always like to make this very interactive. So as we conclude the presentations, we'll also be opening it up to take your questions. I want to encourage everyone to type in your questions in the Q&A field, which you can find on the platform. As we proceed, we will continue to collect these questions, and then at the appropriate time, we will begin to unpack them. So if you are joining us from across the world, I would appreciate it if you can just share your thoughts with us and maybe type in a short welcome in the chat field so we can get a sense of how far this is going. I see we have well over 100 people already engaging us right now, and we look forward to that number growing as we proceed. But if you are joining us from across the world, across Nigeria, please just type in a short hello, good morning message so we can get a sense of how far this is going. All right, so on that note, I would like to now hand it over to Mr. Wole Abegunde. I do believe he is standing by to deliver his welcome address. So Mr. Abegunde, if you are ready for us, I yield this virtual floor to you. All right. For some reason, I am not hearing you. I do believe that there's a challenge with the audio. Hopefully, we can get that fixed in a moment. All right. Maybe we should try again. Okay. We are still struggling with that audio. For some reason, we cannot hear you right now. Okay, perhaps we can just take a short interlude to fix that audio problem, and then we'll get Mr. Abegunde joining us again to deliver his welcome address. Still cannot hear you, sir. Okay, I think you can unmute now. Hopefully we can hear you. All right, still not can't hear. We still cannot for some reason. It's quite strange. Okay, so while we wait for Mr. Abegunde, I thought perhaps we can do a short exercise, and if you like, very unstructured poll to just get a sense of some of the big themes that I think are on the minds of our participants today. Earlier, I had asked that we type in some short comments to give us a sense of where we're joining from. I didn't get any response to that, but hopefully I'll get a response to this. So if you can just take a moment to just type in your your biggest concerns going into 2023, and if you can also type in your what you consider the biggest opportunities in 2023. For example, if you think the biggest issue that will face investors locally will be further weakness of the currency, you can just simply type in that. Let's begin to get a sense of what are the big issues that are on the minds of our attendees today. So if you are joining us and are willing to share your thoughts, please just type it into the chat field so we can begin to collate that. And this, I think, will also be useful for our speakers as they take your questions later on. So, anyone want to bell the cat and type in some thoughts? Is, for example, your concern that the Russian-Ukraine crisis will linger and that will continue to impact commodity prices? Okay, just to clarify, for now, do not type in your comments in the Q&A field. I understand that the Q&A field has been disabled for now. That will be fixed and we'll be using it later on. But for now, I'd like you to type in your comments in the chat field and we can collate from there. Right. Okay. Oh, I see. Okay, the chat is disabled. Okay, so I got that wrong. The chat is disabled for now. I'm just getting those details correct now. But you can type in your thoughts. Okay, so I see someone highlighting the outcome of the elections and the impact on the economy. No doubt that is something that I imagine we should be getting some perspective on from our analysts. Okay. All right, I'm just trying to follow up to get some feedback regarding Mr. Abegunde's connection to see how quickly he will be joining us. Okay. Have we been able to fix that audio issue? Mr. Abegunde, are you with us now? Okay, I see you. But for some reason, I still cannot hear you.
Okay, can you hear me now?
Yes, I think we are.
Okay, my apologies for
All right.
For the technology issue. I have to change to another device to be able to join this.
Please go ahead.
Meeting. Good morning, everyone. It's nice meeting you on this forum this morning. When we do our strategies or discuss our plan, one of the things we take into consideration are variables that are outside our control. So we look at variables that are within our control, and we also look at variables that are outside our control. This year, 2023, has been dominated or is dominated by variables that are totally unexpected and that are out of our control. No one expected that the Russia-Ukraine war will last this long, and no one also expected that it will have the kind of impact it has on the global economy. Two major items have been impacted on by this war. food prices, because between Ukraine and Russia, 30% of the global wheat production comes from this region. Then the energy crisis also came as a result of this war. And these two items have significant impact on the global economy. And as a result, we can see food prices going up. We can see price of energy going up, and countries resorting into alternative source of energy. No doubt, this one will define the future of energy in future, because no country wants to be dependent or want to be at the mercy of a particular country for a strategic item like energy and food. Nigeria was not spared in the impact of Russian and Ukraine war. The monetary policies all over the world increased interest rates significantly in order to curb inflation, which arose from the increase in price of energy and food. We've seen the CBN increasing MPR, trying to curb inflation, which is approaching about 20% in the year by December 2022. Nigeria also is not spared by the expectation of the election. We've had several elections in Nigeria, but this particular election has come with so many fears of violence, fears of what the outcome of the election will be. And we've seen investors in the past, in the year 2022, staying out of the market, the Nigerian market, because of the unexpected outcome of the 2023 election. Investors also converted their investment from naira to dollar. This presented a very dark 2023. But in every dark situation, in every challenge, in every difficulty, there are always opportunities. And our intention is to look at the opportunities that 2023 will present to investors. Know that it will come with high risk, but we know that with high risk, you also have very high return. For us in Meristem, our objective is to guide our and investors on how to navigate the year 2023, because our brand promise is that we are a friendly company with up-to-date market information to grow wealth in good time in an atmosphere of transparency. Our objective is to grow your wealth in good time, and that is why our word in our advert is also always let's grow wealth for you. So I enjoy you to listen to our analysts that have put together this outlook for 2023 and spend a lot of time to gather information to present to us. So please sit back and enjoy this presentation. Thank you.
Thank you very much, Mr. Abigude. And well, finally, we're able to sort it out and to hear you. Thank you so much for setting the tone for us. He did mention high risk, high return. So let's get right into it. What are these risks and what are the potential returns? So to set the tone further for a deep dive into investment strategy and opportunities, I'd like to now welcome to deliver a presentation on the global and domestic economy, Praise Ihasekian. She is the deputy team lead for research at Meristem. Praise, it's over to you.
Thank you very much, Wale, for the introduction. Hello, everyone, and welcome to today's presentation. And we welcome you to join us on this ride as we talk about the global economy. We're going to talk about the domestic economy and also, set the tone for the rest of the conversation. Starting with the global scene, we've seen that a lot of the themes that rock the global scene have already been mentioned. We've talked about inflation, we've talked about rising inflation, slowing global growth, and we've talked about, of course, the Russian-Ukraine crisis. We've talked about the fact that monetary authorities had to pivot, to a contractionary monetary stance to raise their rates. And we've also talked about the fact that all these things summed up, made a very dark tone for 2022. And then, I think we're well aware of all the facts that, impacted the global scene in 2022. So what are we seeing that would, happen in 2023? For 2023, of course, we're expecting that, according to the IMF expectation, global growth is expected to decline in 2023 to 2.7% compared to the 3.2% as estimated for 2022. Some of the factors that affected global growth in 2022, of course, they are still very much prevalent. We're still seeing the Russian-Ukraine crisis, will linger. We're still seeing energy shocks across the world. There's still expectation for, of course, increased inflation rates, but not at the same magnitude that we saw it in 2022. For 2022, we saw inflation. We're estimating inflation rate to be at 8.8% for the end of 2022. However, for 2023, we expect inflation rate to go down to 6.5%. Would like to, I like the fact that while there's an expected decline in the inflation rate for 2023, is not exactly going to be as low as the Global Monetary Authority's target band. A lot of the Global Monetary Authorities have a target band of 2%. So while we expect, that the inflation rate will still decline this year, this 2023, we see possibility that it will not be it will not get to the 2.2% that the Global Monetary Authorities have estimated. Of course, speaking about monetary policy authorities, we still expect that there would be rate hikes in 2020, in this year, 2023. We expect this theme of rate hikes to continue. However, it will not be at the same magnitude as we saw last year, 2022. There's a possibility that the rate hikes for 2023 would be less aggressive, looking at the fact that we're already seeing inflation moderate in a lot of these global economies. Now, speaking to the domestic economy, like Wale mentioned, some of these factors that affected the global economy in 2022 definitely still had an impact on the domestic economy in 2022. We saw that for the domestic economy, while Nigeria still recorded a positive GDP growth, there was a significant decline, or there was a consistent decline in the GDP growth for 2022. As at 9M 2022, we're recording a GDP growth, cumulative GDP growth of 2.94%. That's almost 3%. And of course, for 2023, we still expect that we Meristem research, we still expect that global growth for Nigeria will be positive, but however, it will decline. It will be lower than 2020. It will be lower than 2022. Someone is saying they can't hear me. Please, can anyone confirm?
No, I can hear you. I am not sure why, but we get that comment, but I can hear you loud and clear.
Okay, I just needed to confirm. Okay, so yeah, like I was speaking to our global growth expectation for 2023, we still expect that it will be positive in Nigeria, compared to the global scene. I mean, I think I mentioned that on the global scene also, we've seen some countries record a decline in their GDP growth for 2022. But for Nigeria here, we are still expecting it to be positive this year. However, it won't be as high as what we saw last year. For 2022, we are expecting a cumulative economic growth in Nigeria of 2.17%. And some of the things that feed this our forecast include, the fact that the oil sector, while we expect a recovery in the oil sector for 2020, for this year 2023, we do not see it going to the target band target band that the OPEC has given Nigeria. For instance, as at the last, I think November or December 2022, we're seeing oil production volumes of about 1.2 million barrels per day. But then for 2023, we are expecting that oil production volumes will increase, above the levels that we saw in 2022, given the fact that there's been some improvements in the investments in the sector. There's been some improvements in government efforts to tackle vandalism. However, we don't expect it to get to OPEC's quota for Nigeria. So we are estimating a production volume of 1.5 million barrels per day cumulative or 1.5, at least average of 1.5 million barrels per day for 2023 for Nigeria. However, on the non-oil sector side, for most of 2022, the non-oil sector was the major driver of growth. But for 2023, we expect that some of these non-oil sectors would experience a decline. For instance, the manufacturing sector has already recorded one quarter of decline in Q3 2022, and we expect it to record another quarter of decline in Q4, which would effectively put us in a recession. So for the first part of 2022, at least, we're expecting the manufacturing sector to continue to record a decline, looking at the fact that some of the activities that are affecting trade and some of the monetary policy rate hikes that occurred last year would, permeate the economy for 2022 and we have some of these things, affect the economic growth of the manufacturing sector. Of course, we're also expecting the informal trade sector to be impacted by the cashless policy drive, or at least in the first quarter of 2022. We're expecting that this would also, affect growth in 2022. So cumulatively, while the oil sector would see some recovery in 2023, the non-oil sector should remain positive. Growth in the non-oil sector cumulative should remain positive, but we don't expect it to be as high as it was in 2022. Moving on to talk about inflation, like we mentioned, some of the things that affected the global scene in 2022 included the spiraling inflation. I mean, Wale also mentioned the fact that food prices increased significantly, and that affected global inflation, both food and energy. So, of course, that's also trickled down into Nigeria, being the fact that we are very exposed to whatever is happening on the global scene through the imported inflation index. So we also saw some of these things also affect us in Nigeria. Aside from the fact that we have our domestic challenges too, of course, we have our domestic challenges with agricultural value chain. We had the incidences of fuel scarcity in Nigeria, and some of these things that affected the inflation rates for Nigeria just on the domestic scene. Now, combining those two, the effect from the global scene and effect on the domestic scene for 2022, that we saw the inflation rates rise significantly. For 2023, we still expect that the inflation rates would also continue to rise. However, the imported inflation part of it might not be as significant as it was for 2022. I already mentioned that we expect that while inflation would still increase on the global scene, it would not be as high as it was in 2022. And so, okay, I'm being distracted by the chat box. Maybe I'll just close it out. So for 2023, we would definitely expect that inflation would still increase in Nigeria, but most of the things that would affect inflation rates would be things that mostly from the domestic side of things. For instance, we've not seen any significant resolution to the lasting resolution to the fuel scarcity issues. There's a possibility that there will still be more incidences of fuel scarcity in 2023, and of course the almighty fuel subsidy removal conversation. The question of when speaking too fast. The question of when fuel subsidy would be removed in Nigeria is a very significant thing that's also going to drive the inflation rate for 2023. So for us in 2023, we expect that the agricultural challenges will still affect the food aspect of things. We still expect that there will be fuel scarcity, some incidences of fuel scarcity in Nigeria. We expect that the fuel subsidy, the potential of removal for fuel subsidy would also increase the inflation index, and we expect inflation to continue to go up in 2023. Speaking about inflation, of course, there's going to be monetary policy responses to rising inflation. Like we saw in 2022, we saw a significant change in the monetary policy committee's drive, to foster growth, and then there was a reversal to ensuring price stability. So for 2023, we expect that while the Monetary Policy Committee would not be as aggressive as they were in 2022, there's a possibility that they would see up to 200%. We expect up to 200% percent hike in the inflation, in the monetary policy rate for 2023. So for 2023, we are expecting that there will still be additional 200% basis hike in the monetary policy rate, and then this would be to hike to also kind of stem the rising inflation. We also saw that there was, like I mentioned, there was that currency management policies like the cash withdrawal limits, the removal of the cash withdrawal limits, that's reducing it to 500,000 naira for individuals. And I already mentioned that we expect that to affect the informal trade sector for growth in 2023. So some of these things also are definitely monetary policy actions that we're undertaking in 2022 that we expect that will have impact on the economy in 2023, and also would affect growth and inflation rates for 2023. Speaking to the other side of things, of course, I've talked about the monetary policy. Speaking to the fiscal policy, on the fiscal policy side, we saw the fiscal authority release the 2023, approve the 2023 budget, and we are seeing a budget of about 21.83 trillion for 2023. And this is about 22% higher than what we had in 2022. And so there's this debate on how realistic are the budget assumptions that were used to create the budget. For instance, the budget that expects that inflation rate is going to be about 17.16%. But looking at all the factors that have affected inflation and all the factors that we are expecting to affect inflation in 2023, how realistic is that assumption of the federal government in creating the 2023 budget? Also, the federal government expects that they'll be able to raise production volumes to about 1.69 million barrels per day, going by the fact that while we expect, like I mentioned, we expect some improvements in the oil sector for 2023, we don't see a possibility of the oil production volumes going as high as 1.69 million barrels per day. We project that it will be as high as 1.5 million barrels per day average in 2023. Also, the federal government, the fiscal authority, expects a GDP growth of 3.75% for 2023. And I mean, we're looking at the fact that 2022 already, we're already at 2.9%, 9.4% in 2022, and we are actually expected to decline in Q4 2022 to 2.51%. So looking at all these factors and how the global economy and even the domestic economy hasn't seen so much resolution on the Russian-Ukraine crisis and on some of the issues that are affecting growth, we don't see how realistic the 3.75% expectation would be for 2023. Speaking to the realisticness of the fiscal policy, there's also an exchange rate expectation of 435 naira per dollar. However, for us in Meristem Research, we project that the exchange rates would go as high as 510 naira per dollar on the official exchange rate. That's just on the official exchange rates. Looking at the end of 2022, we're already having the official exchange rates go as high as 450 naira per dollar. So, trying to extrapolate this into what we expect for 2023, we're expecting that the issues that affected the CBN's ability to defend the naira in 2022 would still be very much persistent. While we would see some alleviation based on the external reserve, we would see some alleviation based on we expect that production volumes will increase. On the other hand, we also do not see so much room for growth on the external reserve because we expect it to remain pressured. We expect that some of the factors that like such as the CBN's intervention policies to impact the naira, to uphold the naira would definitely affect the exchange rates external reserve for 2023. Also, we're looking at the fact that Nigeria has a $500 million Eurobond payments expected in 2020, this year 2023, and we expect that would definitely draw down on the balance of the external reserve. On the positive side, while we are expecting that the Dangote refinery will become operational in 2023, and so this should relieve some of the pressures on the external reserve. However, the Dangote refinery is going to act as a double-edged sword because while it relieves pressure on the external reserve for the monetary authority, on the other hand, it's also going to reduce the accretion, the accretion from oil sales into the external reserve. So on the balance of factors, the impact of the Dangote refinery might not be as much as the federal government and the monetary authority, in fact, is expecting it to be. The IMF also has a food shock window that's available to countries that have been affected by the food crisis. And so in a meeting in October 2020, 2022, the Minister of Finance, made a statement that there's a possibility, while they're still assessing the possibility of Nigeria going to the IMF full shock window to get some funds from some FX. We're still considering this, and that is definitely another positive that would impact the external reserve and also, improves the monetary authority's ability, to defend the naira. So on the balance of all these factors, looking at the fact that we expect oil production to increase in 2023, we expect that oil prices would remain at the current levels. We're expecting CBN's intervention to continue to persist. And like I mentioned, the first subsidy removal is a very big consideration that should actually, is a very big discussion that would definitely see the light in 2023, or should definitely see the light in 2023. These are the things that we expect would, impact accretion into the external reserve, and thus the the CBN's ability to defend the official exchange rate. While of course we recognize the fact that the parallel market exchange rate is definitely higher than what we have on the official window, and thus we expect that the parallel market rate would still remain at least 30%, to retain at least 30% premium over the official exchange rate for 2023. And definitely one of the scenes that is very important for the global scene for Nigeria in 2023 is also the tone of the political. All eyes are really on the general election for 2023. The tone of who is going to become Nigeria's next CEO, who is going to clinch the next seat of power. And of course, we've assessed the three major candidates. While there are 18 candidates vying for the top seats, we've assessed the three major candidates that seem to have some popularity. While one of the ways in which this 2023 election is kind of different from what we usually see is the fact that normally in Nigeria there will be two major political parties. On this time around, it's there appears to be another candidate who seems to have some popularity among the youths and the elites. And thus, looking at all these candidates put together, there have been different polls, to assess who is going to win, who is going to be the next president of the country. But for us in Meristem Research, we are of the opinion that the presidential election is going to be a keenly contested election between the three parties, because each party or each candidate has a very strong hold, and they have possibility of gaining the 25% required in all these strongholds. And thus, looking at each of their their market propositions, they're all pro-markets. They're all candidates that have spoken, and even in their action, their campaign trail and their previous records too, they're all candidates that have giving indication of being pro-market, being for the market. So we expect that either of them actually, any of them actually have a very high chance of clinching the top seats. Of course, the consideration of who is going to win in what part is also very significant. For instance, we expect that each of them might be very significant in their political strongholds, where their parties have significant presence, and also these different states and all that. So looking at all these considerations put together, we are definitely of the opinion that either candidates have a very high chance of getting the political seats for Nigeria in 2023. And of course, I've mentioned that they're all pro-markets. They've all been pro-markets in their policies and their political actions. And we expect that either of them would actually have a lot of pull on the market. And, of course, we expect that investors would also, be looking forward to any of them and any of them coming into the seats would definitely be a plus for investors in Nigeria. So that would conclude the presentation on the global and domestic macroeconomic scene. I would hand over to Wale now to carry us on with the presentation. Thank you.
Thank you very much, Praise. So much to get in there, no doubt. And I have no doubt as well that we're going to be taking a lot of questions from our attendees. And just to recognize those that are joining us from across the world. I see people are joining us as far as in the US. So it's great to see that many people are interested in the outlook for the markets here in Nigeria. And you've obviously raised a lot of very important points. For me, the biggest ones include the fuel subsidy removal and how that is likely to play out, the Dangote refineries impact. I think we should have some follow-up questions on that. And the FX supply challenge, is it likely to get worse or remain the same? I think either scenario presents different challenges for investors. And then, of course, your forecast of 510 naira for the naira, I think, to the dollar is an interesting one, which I think some may want to have you unpack further. But thank you so much for the presentation, Praise. And as we proceed now, we would like to now get some perspective on the equities markets. And to deliver that presentation, I'm joined by Investment Research Associate Abdul Latif Grillo, who will be making that presentation for about 10 minutes. Abdul Latif, it's over to you.
Good morning once again, everyone. So I'll be taking us through the equities market outlook, starting with the global equities market and the review of global equities market in 2022. Global equities was quite bearish in 2022 as most global indices recorded double-digit losses across regions, and some of the factors that led to the bearish mood in the global equities market in the year 2022 was fear of a global recession, which led most investors out of risky asset classes like equities. There was also the rate hike by monetary policy makers across regions. And what this meant for investors was it made fixed income investment more attractive relative to equities investment. There was lastly the research COVID-19 cases in China, which also caused investors in that region to move out of the equities market. So we have also put together some factors that we believe we have significant bearing on the direction of global equities market in 2023. And some of these factors include monetary pivoting, like Chris mentioned earlier. So in 2023, it is expected that monetary authorities will put an end to their hiking cycle. And what this means is that most investors will become more comfortable in investing in risky asset classes like equities markets, and investors will most likely find their way back into equities. We also consider the fact that the valuation of most stocks globally is quite low presently, and this presents an attractive buying opportunity for investors looking to enter into the equities market. Some of the risks to this outlook, however, remain the reduced earnings expectation as the fear of recession continues to linger, as well as fixed income yields, which remain elevated. So overall, we expect the global equities market in 2023 to be more positive, much more positive than what we saw in 2022. So moving on to the domestic equities market, unlike the global equities market in 2022, domestic equities market, as the Nigerian bus was quite positive. We saw a return of 19.98% as at the end of the year 2022, making it one of the best performing equities market globally, and also the best performing amongst its peers. But however, looking at the dynamics of the domestic equities market in 2022, it seemed like we had two divergent halves on the exchange. For the first half of the year, we had a much more positive half, with the market returning 21.31%, while for the second half of the year, the market wasn't as positive as what we had during the first half of the year. For the second half of the year, market returned a negative 1%. And this was following the hiking rates by Monetary Policy Authority, which started in May. And what followed that was a decline in activity level in the equities market. We saw investors move out of equities as fixed income became a much more attractive option for them. So during the third quarter of the year 2022, the market lost about 5.39%, making it the first quarter loss in about 5 quarters. Other factors that led to the second half, the divergent mood in the market during the first half of the year was during the 2 halves of the year rather was the performance of the most capitalized stocks on the exchange. So we paid attention particularly to the 10 most capitalized stocks on the exchange, which accounts for about 80% of total market capitalization, and about 7 of these stocks recorded gains during the first half of the year, with likes of Apple, and Stepla gain up to 80%, while only 4 of these stocks recorded gains during the second half of the year. Also across sectoral indices that we track about 7 sectoral indices and merged them research, and we had 4 of these sectoral indices return positive during the first half of the year, as against only the banking and industrial goods indices returned positive during the second half of the year. So it also showed that the mood during the 2 halves of the year was quite like broad-based across sectors. We had most of the corporate actions that we saw in 2022 came in earlier during the year. In January, we had the listing of Foods, which is a heavyweight ticker. We had Dansen share buyback. We also had other actions, the Seplat acquisition and Seplat announced acquisition of Mobi Unlimited also during that period. That caused the value on some of the stocks during the period. And for foreign participation in the market in 2022, foreign participation remained very low as the domestic investors continue to account for more than 80% of total market transactions during the period. So our outlook, we have put together some of the factors that we expect to have a significant, to be the significant determinant of market direction in 2023. And first up is, we know the high likelihood of the market rally in January. So there seems to be the January effect, and this is usually attributable to the optimism that comes with the new year. There's portfolio refinancing activities. There's usually a lot of buying interest. Looking at the past 5 years, the market has closed up 4 out of 5 times in January, and there are also usually corporate actions that are now announced in this period. And for this year particularly, we know that Danske might also come to the market again with the third tranche of its share buyback program. So moving on from January, the highly anticipated 2023 elections is coming up next month, February. And what that will mean is investors will most likely, some investors want to take a wait and see approach for the outcome of the elections. What happens, just hold their cash. And for some other investors, they might want to move to less risk investment, because we know that the volatility, expected volatility in the equities market during this period due to the heightened political risk. So a lot of investors might want to move out of the equities market during that period. And following the election, post-election, the results of the presidential election, whoever emerges at the poll, immediate policy actions, and also investors' confidence, particularly in whoever emerges at the poll, and the confidence in their policies will mostly tell on the stance and decision that investors will take if they'll be ready to put their money back into equities, which is perceived as a risky asset class. So away from that, other factors that we expect to significantly impact on the direction of the market this year is corporate performance. And for us at Meristem Research, we expect corporate performance to be broadly positive across sectors. For the most part, we expect positive corporate performance, and also attractive dividend yield for most of the stocks under our coverage that declare dividends. We expect like a step up of dividends relative to what they declared, and for the yields also relative to what they declared in 2022, which is a positive one for the market. Also, we consider the fact that the equities market seems to be trading at a premium relative to its 5-year average valuation, and also some of its peers at the moment. And this also, what this means is an attractive entry price or entry opportunity for a lot of investors that are ready to take on the associated risk. So overall, we foresee a positive equities market in 2023, and our projections for the equities market is 10.50%. Thank you very much for listening.
Thank you very much, Abdul Lateef. So very high-level thoughts on where the market is headed and the key factors that will impact the markets. I have no doubt that our attendees have questions, and so we'll be transiting to questions later on. But again, I just want to reiterate that if you do have questions or any specific comments regarding anything you've heard today, please type them in the Q&A field so they don't get lost in the chat field. We certainly intend to take as many questions as possible, and we'll be transiting to that later on in the program. But in the meantime, we want to now get some perspective on the fixed income markets. So let us now listen to the co-managing partner at Commercial Partners, Mr. Nnamdi Nwizu, as he shares his thoughts on the fixed income markets in 2022 and what the outlook is in 2023. Nnamdi, it's over to you.
Yeah, good morning, everyone. Unfortunately, I didn't prepare a presentation like everybody else, but we just go through basically what has happened, what happened in the market last year, and what we expect to see this year. So, I mean, first of all, we'll not look at just the local markets. We also have to look at the Eurobonds market to understand, you know, the position that we find ourselves in. So, if we start with the Eurobonds market, it was what we call bearish last year, which means that prices were basically dropping and yields were going up. We saw Russia-Ukraine crisis further exacerbate the issue or inflation. We also noticed that you had an aggressive hawkish stance by the Feds, right, the Reserve Bank in the US, where they raised rates from 0.25 to about 4.25, 4.5 levels. So basically about 400 basis points increase based on, you know, very high inflationary pressure seen there. And we saw investors moving, safe haven, going to things like US Treasury, gold, and all of that basically affected Eurobonds market. We saw Sub-Saharan Africa Eurobond yields really suffer. Some yields went up as high as 20%. If you look at Ghana really, I think, was the hardest hit of all the countries, and they're in the middle of a $3 billion IMF bailout, followed by also Egypt that had some serious geopolitical concerns. I mean, we've seen what has happened with Ghana and how they're struggling to pay interest or pay their coupons on the bond, service their debt. And they've sent out proposals. They're restructuring their local debt, restructuring their Eurobond debt, and they've suspended paying interest. So that basically gives an idea of what's happening in the Eurobonds market. We also saw Kenya struggle. I think the only country that performed in the Eurobond market space pretty well was Angola, because even Nigeria had yields also go up roughly about 3 or 4%, which you have to understand that when your yields go up about 3 or 4% in dollar terms, it's pretty aggressive and it's pretty high, right? Then if we look at the local market, started out pretty bullish in the first quarter, where we saw quite a bit of buying across different maturities. But then MPCs started to hike rates, looking at inflationary pressure, where we saw inflation go from 15.6 start of the year to peak at about 21.47. And beyond hiking rates, we saw the central bank also come out aggressively to continue to debit for CRR, which is the cash reserve ratio or cash reserve, ensuring that they continue to debit banks. Some banks have about 80 or 90% when you're looking at what their cash reserve ratios are versus the CBN 35% or the 32% limit that they've set. And naturally, the constant debits led to thinning liquidity in the market, and we started to see yields go up, alongside the fact that the DMO had to issue quite a lot because they had about 3 trillion that they needed to cover, and that had a big effect on the markets, right? We saw bond yields go up about 300 basis points, and treasury bills jumped by about 400 basis points throughout the year. And also, CRR over 13 trillion from central bank, and then we'll have all heard about the ways and means. Ways and means basically is the central bank's lending to government. And over the years, it's gotten up to 20 trillion, which is, I would say is a crazy amount. Last year alone, they had about 6 trillion in borrowings from the central bank. So basically what we have seen is the government has been unable to meet their Naira demand or Naira borrowings in the local market, and they've had to go to the central bank to loan them money. And this huge ways and means figure started roughly about COVID period, with a huge reduction in revenues and huge expenses, increasing our deficit. And the government decided to look to the central bank to help plug the hole, and which is how we ended up with over 20 trillion in loans from the central bank to the government, which they are now trying to convert to bonds. Coming into this year, what we expect is that we would see the Fed at some point in time slow down in their rate hikes. Last year was about 400 basis points that they did. People are expecting anywhere between, say, 100 to about 150 basis points this year. And if that happens, then we might start to see yields in your Eurobonds market, the Sub-Saharan African market start to come down. But even then, it still might not be conducive for Nigeria to borrow in the Eurobonds market. And I would expect to see them still come to the local market and focus on, borrowing funds from there, which we can even see from the budget figures and from presentations done by the Minister of Finance. They talked about borrowing about 7 trillion from the local market versus 3 trillion that they borrowed last year. And then 1 trillion will be international market. International market, I'd expect it to be more multilateral agency type loans, maybe IMF or World Bank or those kind of type structured loans, because the Eurobond market is still not conducive for them unless we see yields come out aggressively. Because if you look at most of the coupons and where government has issued, it's been in the region of anywhere between 6.5 to about 8.5% coupon. But now you're seeing yields at about 12%, which means that if they were to come out to borrow, they'll be paying 12% or higher, which is way too high for government. They'd rather just switch to local borrowings than go and take on dollar long-term debts at those kind of levels. So, I mean, a lot will depend on what MPC continues to do, and also what the central bank does with regards to CRR debits. Also, when the Ways and Means 20 trillion, if it's approved and it gets converted to a bond, will the central bank start to create new ways and means and start to fund government all over again? Or will they cap it where they are and government would have to focus on raising all their funds in the debt market? So that is a big thing that one has to look out for, because that tells us whether or not the whole 7 trillion that they plan to get from the local market actually comes from the bond and T-bills market, or if we're going to see that some of it coming from the central bank once again, you know, with the Ways and Means. If we look at liquidity in the market, we have quite a bit of liquidity coming in Q1 up until I think about April, where we have about 750 billion maturing in bonds. And if that happens, then we can expect to see that help moderate the uptick in yields. And maybe some downward pressure around when we have our 750 billion maturing in April. But post that, maybe have a bit of a bullish run, you know, post-election. I mean, we expect everything to go well, have a new president. If things are positive, you might see a bit of buying. But after that, I think reality will set in once again. And we'll see the size of the borrowing that government needs to do. And that might end up pushing yields back up again. And we'll start to see government struggle to borrow. Unfortunately, they don't really have much of a choice. If you have expenditure at 21.8 trillion or thereabout, and 11.34 trillion deficit, right? Then you're really going to have to, push up your yields if you're planning to hit the local market to borrow. 3.27 or thereabout borrowed last year, and we saw bond yields go up by about 300 basis points, and they're still elevated compared to where they started last year. If we come in to borrow 7 trillion this year, then we're definitely going to see that market, spike a bit more. So it'll be interesting to see what happens with the Ways and Means, what happens when the current 20 trillion gets converted to a 40-year bond at 9% or thereabout, and see whether the central bank continues to fund government all over again. And that would help give us some clarity as to direction for the market. But for now, we expect to see very little issuance, almost having nothing at all in the real bonds market from the government, and increase local borrowings from bonds. And I think they'll try and be heavy on the treasury bill side, because it's difficult to try to raise 7 trillion in the bonds market. So definitely, I think they would have to increase their issuance volume in the treasury bill market, and I guess time will tell. Thank you.
Thank you very much, Nnamdi. Very valuable insights. High level to some extent, but I also like the specifics in terms of some of the calls that you have made. And no doubt we will be hearing from our participants, and they will be sharing their questions and comments in response to your presentation. We'll now move on to our next presentation as we take a look at the commodities markets. And earlier, Mr. Bigude mentioned food prices as a concern going forward. So let's hear now from Mr. Akinka Akintunde, Managing Director of FX Nigeria, as he shares his perspective on the commodities markets moving forward. It's over to you, Akinka.
Hi, Wale. Hi. Good morning, everybody. It's always a pleasure to be here, and I want to thank the Maritime team for giving us the opportunity to be here. It's been an interesting year for us, and globally, we've all mentioned the interesting dynamics going on a global scale, and there's no doubt that the Nigerian commodities ecosystem is very much exposed to the international commodities and political dynamics. And this became more apparent, especially during the COVID-19 crisis that rocked the world, which shook us to the bones, because during then, a lot of countries took a protectionist stance towards their food production, which is natural, right? And Nigeria was left exposed. On the back of that, global food prices touched an all-time high.
I apologize, Akinka, for interrupting you, but we cannot see you right now. I wonder if
I think my video is being disabled. I'm trying to start it. I can't.
Oh, I see. Okay. I'm sure the team here will look into that, but please keep trying as you proceed. Please go ahead.
Okay.
Hopefully we should see you soon.
Hopefully. Okay. So global food prices and commodities prices generally reached an all-time high at the Q1 of 2022 after experiencing a volatile 2021 period, and the Russia-Ukraine crisis, which is one of the key production baskets for some of the commodities we consume locally, and the source of some of the raw materials consumed globally, especially on the energy industry, did not make matters any much better. We've spoken about a lot of the issues on the global scale, and I'll draw less on that and then highlight the key factors that we've seen here. So Russia-Ukraine war was a key determining factor for 2022. Hopefully, we come to resolution soon across that front, and then the impact is muted globally. Currency depreciation in developing economies was also a factor that affected food prices in the country because of global dynamics and how exposed the country is. Globally, slower growth was a key resounding theme, especially in the developed countries, right? If you follow the news, especially as the aftermath of the Russia-Ukraine war, Europe and the UK were very much exposed to high energy prices. A lot of countries across Europe were able to weather the storm, but the UK still battled with it a lot, and it had a dire effect on their economies. We can't run away from the fact that climate change is becoming a recurring theme for us globally and for us as a country, and we can't run away from the fact that it's something we need to pay attention to. Now, these are some of the factors that affected global production. On the local fronts, due to reduced input usage, if you're not aware, Nigeria imports a lot of its inputs and do a lot of local blending. Because of the global dynamics going on, importation into Nigeria, especially driven by the high FX cost, made it very, very difficult for a lot of producers to go to farm and produce these foods that is required for consumption. On the back of that, we saw a lot of reduced outputs across key commodities that were produced locally: maize, rice, sorghum, soybean. With the exception of soybean, actually experienced reduced production. And weather conditions did not help matters. Everybody was aware about the flood that rocked the nation some months back, which affected lots of farming activities across the country. All this contributed to lower stock for the country in 2022. And on the back of that, we're expecting this to have impacts in the coming year, in this year that we've started as at now. The good thing about it is the year started with increased stock globally, right? So the 2021-2022 season saw massive production across most commodities ecosystem. And a lot of consumers of these commodities actually had a lot of stock to begin the season with. So the price effects mid-year to end of the year was a bit muted, and it was reflected in the prices of commodities that was traded across the country. We keep seeing volatility in prices of these commodities. For us, being able to provide insights into how prices of commodities affect the economy and the potential impact on financiers is key for us. And volatility in the market keeps increasing. And people and producers especially keep looking for innovative ways to access finance And the processors also look for innovative ways to ensure that they can sit on their stock. One of the key issues that is facing us in Nigeria is the fact that we're a mono-seasonal economy, meaning that we produce commodities once in a year. And when everybody goes to produce, when it's time for harvest, everybody chases the limited stock that is available, which makes the prices to skyrocket. And at that point is where most producers actually sit on the stock that they use for the season. Meaning at the beginning of each season, there's huge demand, financing requests from producers to be able to sit on stock that is required for production. And the interesting thing about this is the fact that this commodities prices is one of the few drivers of inflation that we could directly see and project the impact of what we are likely to experience as a country, right? When you estimate that the level of production of commodities is reduced, prices of fertilizers and inputs are on the rise, and less farmers don't have access to financing to even access what is required to produce the commodities, then the direct impact is going to be an increase in food prices. And this has been a recurring theme, especially in the last 18 months for the country. And we don't see that going down anytime soon. From the earlier speakers, it's been clear that the political outlook is not very favorable as well, as we expect that the dynamics will be much more prominent in rural communities, which are majorly prominent production areas for commodities. And the impact of this is going to have a direct reflection in the price of food later on in the year. The production period is usually around March, April, May, which is conveniently post-election. So the presumed outlook is after the election, business goes back, the economy goes back to business as usual. If that is the case, then food prices is expected to be muted. But if it goes otherwise, then we're in for a long ride in terms of increased prices of commodities that would be consumed locally. On the domestic front, a weakened price of the currency is actually one of the key determining factors of food prices. And as I'll show later on, we've seen from our experience a direct correlation between food prices and the value of the Naira. So when you see the Naira weaken significantly, then you're likely going to see an increased prices of these commodities, which will drive inflation to a higher level and make it much more pricey to get food items globally. Impact of flood cannot be underestimated. It's a recurring theme that we need to tackle as a country, and the earlier we look into it, the earlier we can prefer solutions that solve most of the issues we face. There are lots of structural challenges that are still lingering on for us as a country. And one of the key factors is what we refer to at Apex as the absorptive rates of the country. Now, this is what we describe as the ability for us to store enough food for the population in case of any externality happening. And from our research, global practice is for you to have at least 80 to 100% of your production capacity in storage every year to serve as a buffer for at least 6 to 8 months in case there are externalities. For Nigeria, the capacity we are at right now is 5%. And this is driven majorly by absence of good infrastructure like storage facilities, silos, operationalizing it at efficient cost and co. These are areas we believe are requiring more investments to drive, driven majorly by the private sector and fully managed by the private area. And the more of this that we have in the economy, the more buoyant we are in terms of food stability, production increase, efficiency in yield, and then unlocking financing to drive agricultural productivity in the country. Some key factors that we believe will shape the outlook in the year are listed there. For us, we still see deteriorating growth globally affecting production for us in Nigeria. Since we are highly import dependent, there will be an increased cost of these inputs coming up in the country, which will make it much more difficult for farmers and producers of these commodities to have access to the inputs required. On one side, like the first presenter mentioned, right, the Dangote refinery is a double-edged sword. And for us, the way we see it is the fact that Urea is one of the key components that is required for food production, which is one of the material that is rolled out from the plants at Dangote. But the other side of it is it has good FX value for the business, right? So the question is, would the refinery focus more on servicing the local economy or focus more on selling in the international markets? This is a key determining factor that will affect a lot of activities globally, nationally, and then help drive how the food prices will flow in the coming years. Most transport routes globally, the River Mississippi is a key transport route and is drying up, and this would actually impact logistics and delivery of goods globally, right? So we expect much more hiccups in global dynamics and shipping across board, which will also affect our importation of goods significantly. Like I mentioned earlier, input cost is one of the key things that we need to look at. And then global trade policies are things that we also need to keep an eye on, as they have a direct impact on the business and on the country for us as a whole. From one of the engagements we've always had with producers of commodities, away from popular opinion, one of the issues we've seen for farmers is actually timeliness of access to key quality inputs and finance that is required for production is actually what drives the volume of production that we have globally, right? So if the producers of these commodities could get access to finance early on, irrespective of the cost that it comes to them, then we see a lot of them going more to the farm and producing these commodities. But if the timing is off, then we're in for a long ride that will continuously hike food prices for us as a country. And this is one of the areas we see opportunities in the coming year. Yes, there are lots of global factors that are going on. We see prices to still be elevated with no respite in terms of coming down. We still see production volumes going down because a lot of dynamics are making it impossible for people to produce more. And all this accumulates to create opportunities where people in the ecosystem, especially in the capital markets, could add value on. One of the key things we believe is product development that helps to shape and drive innovative products that we could use to access capital and drive production of these commodities. And just to put that in context, if you look at the agriculture as a percentage of GDP is above 3% of the GDP. And to be more specific, if you look at grain production in the country, grain production is about 2.7% of our GDP. Meaning if you focus more on this area that is currently at below 60% productivity, then you get to increase value on the grain side and on the GDP as a whole. And one of the areas we believe creates opportunities for investors and players in the global markets as a way to diversify their portfolio is being able to invest seamlessly in the commodities ecosystem. We've seen the Securities and Exchange Commission more actively engaged in ensuring that the commodities ecosystem in the country works, and we still see them putting more efforts on the back of that. Close of last year, we saw them approve some products to be traded on the FX Commodities Exchange, for example, which creates a pathway for investors to be able to play in the markets. Like I mentioned earlier, we see commodities having a direct correlation with the valuation of the currency. So as an avenue to ensure that you protect the upside in a highly likely devaluing environment, then investment in commodities is one of the key areas that investors could also look at. Aside the fact that it hedges against inflation due to the high correlation with food prices and the likes, is a likely place that people should look at as well. And then theoretically, the commodities diversify your portfolio. So investors seeking to invest in that area will be a good one for them. We believe in infrastructure, right? Like I mentioned earlier, availability of storage facilities will also help unlock capital to drive commodities in the market. And this is one of the pillars that we are building for the commodities ecosystem, investing in storage facilities and creating an avenue where investors could actually partake in this whole structure to ensure that they have a decent return on their investments whilst diversifying their portfolio and then ensuring that the market works. So basically for us, we believe that the year 2023 will be an interesting one. The outcome of the election will determine a lot of things, as the outlook for the year is highly dependent on that. High inflation or increased price of food prices is still likely to be sustained, except there are some significant changes in financing of producers, and then keying of key capital market players to drive this will also be a plus for the economy. All in all, it's going to be an interesting year, and we are all here to witness it. Thank you very much.
No doubt. Thank you so much, Akinyika, for that presentation. Again, a lot to unpack there, especially with respect to the outlook for production. We would get to the questions that our participants are sharing at the moment, just after this last presentation, which we'll be having on investment strategy. And that will be presented by Damilare Ojo. He is the head of research at Maritime Securities. Damilare, it's over to you.
Okay. Okay, thank you very much, Wale. We need to share. Okay, we need to bring down the format screen, please, so that we can share.
Oh, okay. Akinyika, if you are sharing your screen, we need you to stop sharing so that he can project his.
Okay, while that is going on, so I'll just say thank you to all the speakers so far. I mean, they've laid the foundation for the investment strategy that I'm going to speak to, right from the global and the domestic, macros outlook, the equities markets, which was both of them spoken to by my colleagues, the fixed income, review and outlook, which has been taken by Mr. Nnamdi Nwizu, and the commodities market, which has just been delivered by Mr. Akinyika. So the investment strategy just sums up, much of the things that have been spoken to. Of course, Mr. Akintunde has spoken to the need, the dynamics in the commodities market as well, and has also spoken to the key infrastructural needs that that are as a call to action for the commodities space. So I'll be focusing more on the equities and the fixed income markets for investment strategy. And speaking to equity first, what we've done is from our outlook, we've summed up a couple of criteria that we think that investors should pay attention to. We have already done that work, and we've come up with we came up with a strategic portfolio based on this criteria that have been shared on the screen. And my colleague has mentioned that our full year outlook for the equities market is that it's going to there's going to be a gain of about 10.50%. And based on that, we've checked different sectors, our outlook for different sectors and for specific companies within each sector. And we said that these are the criteria that should inform how investors should invest in the equities markets in 2023. And one is the omega ratio. And then we are looking at, despite the fact that it's going to be a tough or a rather tough macroeconomic environment, as has been presented earlier, we are looking at companies that still have projected revenue growth, profitability growth, both for top line, bottom line. And we also looked at the returns, expected returns on equity compared to the cost of equity, the cost of investment. And then we also compared the industry margins with that of the individual stocks to determine which ones should be invested in. And based on that, we've come up with this strategic portfolio. This strategic portfolio has been selected from those criteria, and what we are expecting is a combination of dividend yield and upside potential for each of these stickers that have been presented in this portfolio. And based on what we are projecting, we are expecting that if this portfolio weights are used, and our projections, we are expecting that this portfolio, a portfolio that is composed of these selected stocks is going to return about 41% in 2023. We are going to be sharing this as well. So I've spoken to the criteria, so I don't think I need to draw more much on what is there, but what is important is that the expected dividend yield and then the upside potential, is what has been, both of them have been summed up to give us the expected total return for each of the tickers and for the portfolio that has been constructed. And moving on to the fixed income, strategy. Earlier, Mr. Nwizu spoke to what is being expected of, this fixed income market in 2023, and that is also not different from what we have written in the full outlook that's that has been shared before today. And based on the expectations, based on the the outlook for the fixed income market in 2023, for us here, we think that a duration management strategy is key to maximizing returns in the fixed income market in 2023. And what this speaks to is a combination of bonds with low modified duration in order to minimize the impact of the expected volatility in yield in 2023, and then coupled with the fact that those bonds have high yield. So a combination of bonds with a combination of these two criteria, low modified duration and high yield. And based on that, we looked at the currently listed FGM bonds. These bonds are listed on the FMDQ, and we've selected these ones that are presented in this table. And the closing yield in 2022 is presented, the coupon, the duration, as well as the forecasted yield for each of these bonds is also presented. So we think that these are the bonds that should be invested in. And also speaking to the Eurobonds markets, which has also been spoken to earlier, the challenges with some African countries and the outlook for them in 2023. Based on that, we looked at the macroeconomic fundamentals of each of these countries. These African countries that we've selected, and we also looked at the 1-year default probability, which is calculated based on the Bloomberg default risk probability model. And we also looked at the credit ratings and the credit outlook. Of course, the rating is one, the outlook is another thing. And based on that, we combined this macro fundamentals with the probability of default and then with the credit ratings and outlook to come up with this recommendation. And the ones with the comments means that they are recommended, which include Angola, Kenya, Nigeria, Rwanda, and South Africa. I wouldn't spend much time speaking to each of them because Mr. Nwizu has already has done justice to that, and we have more details in our full year outlook, which is accessible to everyone. But essentially, we've said that these are the our recommendations for these key countries. And the next question is then what should be the composition of an ideal fixed income portfolio based on the outlook for 2023? So of course, we know that in the fixed income markets, we have different instruments, including commercial papers, treasury bills, corporate bonds, FGM bonds, and Euro bonds. These are some of the fixed income instruments that we know are out there. And based on the outlook for yield, we came up with a proportion for each of these different instruments, what we think is ideal in order to maximize returns in 2023. And we also looked at the duration of each of them, because you recall I mentioned earlier that duration management is very key in 2023, given the outlook for yield. And so we think that a commercial paper, an ideal fixed income portfolio in 2023 should have commercial paper of up to 30% in proportion. For treasury bills, should be composed of about 20% of the total portfolio. And this is because for these two instruments particularly, we know that they typically, they tend to have low tenor, and you can, as yield is increasing, maturities from these instruments can be used to reinvest in high yielding instruments and to also minimize the impact of duration that I've been emphasizing before. And then for corporate, that should take up to 20%. Relatively, they are relatively less liquid compared to treasury bills particularly. And so we think that it should still have up to 20% because we think that I mean, their duration seems to be moderately high. Then for FGM bonds, we think that they should have 15, should be about 15% of an ideal fixed income portfolio to maximize return in 2023. And for Euro bonds, we think that they should take up to 15% of a fixed income portfolio in 2023. And like I said earlier, there are more details of all of these things in our full year outlook. And I think at this point, this, we would bring our presentation to an end. And I'll hand over to Wole now. Thank you.
All right. Thank you very much, Damilare. Very useful insight again. And as you can probably see, we have a ton of questions in the Q&A field, and we'll be getting into that very shortly. But again, I just want to reiterate that if you do have any questions or comments regarding all the presentations that we've heard so far, please type them into the Q&A field. I will do our best to run through all of them before we wrap up today. Now, I imagine that many questions will overlap in terms of their similarity, so we'll do our best to put all things together. So on that note, I want to ask that all our presenters switch on their video cameras so that we can get right into this phase of the conversation. All right, but before I get into what others are asking, just a couple of points that I think are very general, and I'll start with the fixed income markets. And Nnamdi, if you can give me a short answer to this, the potential contagion of what many are expecting with respect to default by Ghana. We've already seen them already signal that weakness in December. And while they're trying to figure out things with the IMF, there's still that view that risk is still very high. So when I ask about contagion, not necessarily the potential for default by other Eurobond issuers, including Nigeria, but just to get your thoughts on the likely impact of the pressures that we're seeing in Ghana on Eurobonds, because as I'm sure you know, many are already invested in these Eurobonds. If these yields continue to rise, that means they're taking more losses.
Yeah, thanks, Wole. I think there are two sides to it. So first of all, what's happening in Ghana, you definitely have investors a lot more circumspect when it comes to sub-Saharan African, Eurobonds, because it shows that what can happen is real. We saw, I've forgotten some other country default also last year. We know that Ethiopia is also having their own issues. Their yields are about 34%, so they're in distress level. So basically, you have two sub-Saharan African, Eurobonds countries, already struggling. So that's Ghana and also Ethiopia. So naturally, people would start to look a lot more, on other countries. If you look at Nigeria, for instance, where you have your debt service to revenue at 80% or 85% or thereabouts, are likely to get worse this year, because by the time you add additional borrowing that they intend to do, and naturally what that means is that your debt service jumps up once again, right? So, I mean, that has led to what has happened with Ghana, other countries, has basically led to yields staying elevated in the Eurobond market space. So we're going to see a lot more due diligence, a lot more analysis, a lot more country visits. I mean, even for us, we were in Ghana last year, December. We plan to go to Kenya. So we're not just looking at what's coming out from, research documents. We want to see what's on ground and try and see what people are actually, what do people think, even right down to your taxi drivers and co. These are things that one wouldn't have done, 2-3 years ago, right? But the flip side is that the fact that a lot of countries are struggling or might not come out to issue means that it also limits new issuances, which naturally means that it might end up making a Fed for somewhere down the line decides to stop tightening and maybe even look at a way of trying to ease a little bit, if we have a global recession and US starts to struggle, people will turn around and look for where to put their funds. Looking at sub-Saharan Africa space, they look at certain countries. And when they look at those countries are not issuing, other people are not issuing. So it suddenly means you have limited supply. And that might help moderate the uptick in yields, or that should help moderate the uptick in yields. So one contagion effect would be a lot more due diligence. People asking for a lot more, people reluctant to get into sub-Saharan African Eurobonds, people looking for other outlets versus just jumping into high yielding environment as they used to, right? So demand might reduce. But if you now have the Feds turn around and start to ease, and you don't have new supply coming in from sub-Saharan African space, like I said earlier, then that might start to make the countries that are healthy. You know, if you look at Angola, which is doing pretty well with the IMF program, what that means is that you're going to see possibly a lot more demand for the Angolan paper, right? If you look at a lot of Francophone countries, their yields, their bond yields have done pretty well. You know, Gabon and the rest, they've stayed in pretty low digits. So those ones, people seem to be confident in them. But I expect to see a lot more due diligence, a lot more questions asked, a lot more analysis, and people willing to pull the trigger a lot faster if they start to see yields go back up.
Okay, I did ask for a short answer, but I guess it was tough to do that. But a quick follow-up, specifically about Nigeria. Earlier, there was in the presentation, Praise mentioned that there is one of the Eurobonds that is due to be redeemed before the end of the year. Maybe we can pick that one specifically. And as you discuss that, what are your thoughts about the outlook for the Nigerian, specifically the Nigerian Eurobond yields?
Well, typically what should happen should be you have a maturity, and Nigeria will come out to issue ahead of that maturity. And that is typically what will happen. But if yields remain elevated where they are, then we most probably are not going to see that happen, right? For Nigeria, I think that we don't see a big spike. Like I said, I think most of the Fed major tightening is over. Worst case, maybe they'll do 100, 150 basis points this year. And Nigeria, I doubt, comes to the market unless something changes. So that should make us more attractive. The good thing about Nigeria is that they've been able to keep a high level of foreign reserves, right? So foreign reserves are at about 36, 37 billion. Gives people a bit of confidence, even though, yes, we know that in those reserves, they have a lot of swaps and all sorts of things, you know, in there, but still, the healthy reserves for a lot of investors says to them, well, at least to some extent, Nigeria can continue to service its foreign debt. It just means that the reserves will start to go down, but they will still be able to meet their payments due. So I think on the Eurobond space, I think Nigeria turned out well, as long as we continue to keep our healthy reserves.
Okay, thank you for that. Before I take the next question, and now we'll be going to the Q&A field to take some questions. Just want to reiterate that if you do have questions, please type them in. I do see some attendees raising their hands. We would not be unmuting anyone to ask their questions. So please, if you would like to participate, type in your questions or comments. All right, Tondo, on that note, I want to go to Praise. And Praise, again, if you can give us a short answer to this, because we have quite a few questions to run through. Akintoye is asking concerning the manifestos of the three leading candidates ahead of the elections. And I wanted to hear your perspective on what we can anticipate. You did indicate in your presentation earlier that they seem to be all business promoting type candidates. What are your thoughts about what you've seen so far in terms of their plans?
Okay, I mean, the question is already a long answer question, but I'm going to do my best to shorten it. I mean, looking at the three candidates, we know that assessing their previous, their previous track record and some of the things they've mentioned in their manifestos. For example, for the APC candidates, well, I mean, is more focused on optimization of economic growth through job creation. We expect, credits facilities to SMEs, which are some of the things that he has, indicated, in his previous, engagements, and of course in this campaign trail also. For the PDP candidates, is of course a pro-market candidate. We've seen him have a stint in governance, when he was the vice president of Nigeria, and during that time there was a lot of privatization of government organizations. So we also expect a private sector-led economic development, federalism, and restructuring in that line. For the Labour Party candidate, of course, first of all, the party is very focused on expanding labor and all that. So for the Labour Party candidates, we also expect him to have more of a public-private partnership, public-private partnership, private sector-led economy. And he's been very vocal about what he wants to do with imports and exports and all those kind of things. And of course, there's, for all three candidates, there's that conversation of either of them is actually going to, remove the fuel subsidy bill and all that. So that just to give like a very short, I don't know how I can answer this question, in a very short space of time, but looking at what three of them have said, they want to do, the analysis on the general analysis, like you mentioned, Wale, is that they're all pro-market candidates. And for some of them, I think I've already mentioned some of the things that I can highlight, specifically.
No, that's great.
I don't know if that does justice to it.
I think that's useful, but just to follow up, because you did mention the fuel subsidies, and obviously that has been a very contentious issue. There is just that feeling that this might be the year where something significant will be done to address it, because it's now the burden on the government is so significant now at such a difficult time economically. How do you see things playing out with respect to that?
Okay, our position here is that it's high time that the fuel subsidy removal is actually, is actually actualized, because we see it as something that is like I mentioned during my presentation, it has had a very significant impact on the external reserves. Accretion to external reserves has been depressed due to that fuel subsidy payment. However, we don't think that it should be done at once. We think it should be done in phases. And of course, we have different scenarios for our expectation for fuel subsidy removal. On the one hand, we have, a scenario that plays out that if the current party, the ruling party, also wins the presidential election, there might be a possibility of fuel subsidy being removed before the next government comes in. However, there's also the side that to just make way for the next person coming in and make his way smooth. However, if another party wins, apart from the ruling party, there's a possibility of the first subsidy removal being later in the year, or possibly not even this year. But then the three candidates, have definitely highlighted their willingness to remove fuel subsidy, remove the first subsidy bill.
Yes, but again, I'm thinking if they do move forward with the plans to remove it, what are the ramifications on the economy? Because my sense is that given where the oil price is right now, the effective price of petrol will be very significantly higher than it is today. That obviously should have an impact on the economy, and could that potentially even force another recession?
Yeah, like I think I mentioned this during the presentation also, that one of the things we are considering for that would increase the inflation rate for 2023 is the potential removal of the fuel subsidy bill. So definitely there are talks about the effective rate of the PMS being over 400 naira per liter. So definitely the removal of that fuel subsidy would exert extra layer of pressure on prices of various commodities. It would definitely have its own impact on inflation. And then should this most of these economic variables, they are intertwined, so should this first subsidy removal be done maybe at once? That's why we are positing that we were suggesting that it should be done in phases, to reduce the pressure, or at least ease ease Nigerians into the impact of it. So we expect that, it's done in phases. It's definitely going to have impact on inflation rates. It's going to have, we could see the Monetary Policy Committee also responding to this, and then in conjunction to the response we've seen this year, that could lead Nigeria to lower economic growth. But then we don't really expect Nigeria to go into a recession in 2023, given all these factors.
All right, thank you very much. Okay, let me go to Akinka right now. There's a question here regarding the floods, and I also noted it. If you can just speak to the lingering effects of that into 2023, and many will even suggest that potentially there could be another round of flooding in 2023. But let's start with what we saw last year. Very significant, no doubt, especially in the middle part of the country. What has been, in your view, what is likely to be the short to medium term impact of that on prices?
Thank you, Wale.
Okay.
Okay, yes, I wanted Akinka to answer that. Please, go ahead.
Okay. So I think the impact of that will be continuous, will be persistent, elevated price of commodities on one side. On the other side, because we produce every year, right? And especially if you look at most of the crops affected, paddy rice, majorly, people are already going back to farm these commodities, right? So if we have more increased production of these, then it could mitigate the potentially high impact of these commodities due to scarcity of the commodities this year, right? I think the key factor is multifaceted, right? The first would be, is there anything we can do to prevent the flood in the short to medium term? If it does occur again, I don't think so, because it's more of a infrastructural issue that requires considerable investment on the side of governments, whichever way they want to do it, either through a PPP partnership or raising financing for it, which is not visible. If we're able to fix that, then it solves this problem. But I don't see that happening in the short term. It's going to take a longer time, and that is even if it happens. And then if you also look at the cycle, in quotes, of this flood, it doesn't occur every year, right? So the outlook is not likely going to occur this year, right? So a lot of people are now going more to produce these commodities. We should expect increased production of paddy rice and most of all these commodities that were affected into the markets. If it's increased production in markets, prices should be muted. Yeah.
No, but that production, because obviously we're not on the ground there, but given the devastating impact of those floods, would you say that those agricultural activity is already taking place again in those areas?
Yes. So the flood came, right, swept away the goods, the commodities on the farm, and went down, right? Because the impact of the flood is more or less gone. The actual flood is more or less gone right now. It's the impacts we are feeling right now, right, in terms of high food prices. Now, people are going back to farm, especially being the dry season, right? So a lot of people can actually farm their commodities and use irrigation as a substitute to rain-fed farming to increase their production base.
Okay. Thank you for that. All right. Festus is asking about Meristem's advice on investments in equities. And he covers quite a few things. Investment in equities, whether to buy FX and keep, can FX go beyond 800 Naira at the parallel market? So I think it's an opportunity to just touch on that very important theme, the outlook for the Forex market. I do recall that your presentation, Praise, you mentioned 510 as what you thought could be the likely levels for the currency in the official market. But Larry, maybe you can also chime in on this point about how you see investments related in FX in FX denominated assets as an opportunity, even though I do imagine that means going outside the country. And while you're on that point, you may want to also touch on a question around new gold, because someone did ask the question about whether or not it's time to buy that asset. I think there has been a lot of focus on gold, especially given the tough year, if you like, that crypto had in 2022. So Larry, do you have any thoughts on this?
Okay, thank you very much, Wale. Thank you for the question to the participant. So on, FX, I mean, like you rightly mentioned, we've presented our outlook for the official markets, but the question is, how significant would the disparity be between the official market rates and the parallel market rates? We know that, that's premium has been high for a while, and that is because of a lot of demand a lot of demand goes into the unofficial market, which we call the parallel market. And of course, a lot of people do that for speculative reasons, Do we see an ease to our FX issues in the short term, particularly in 2023? Praise highlighted some of those, an answer to that earlier, being hinged on a couple of factors, including where oil production is going to be when fuel subsidy is going to be removed. And, those are some of the key issues, and where oil price as well is going to be. And in 2023, I think that where the parallel market rate is going to be is also going to be hinged on who wins the election, and why that is. I'm trying to tie that to the policy direction, right? As it is now, where we are currently, if where we are currently is where we are going to be at the end of the year, I think that there's still going to be a lot of volatility in the parallel market rate, because there's really no, like our outlook topic says, dark clouds on the rise, and there's really no no end in sight to the challenges with regard to our FX here. So the demand, speculative demand, and coupled with the fact that a lot of, even those who have legitimate use for FX, manufacturers, we have a list of demand that have been banned from the official market. So those demand, of course, are channeled through the parallel market as well. And that demand is still going to be high, if where we are right now, in terms of the regulatory environment is where we are at the end of the year. So if there's a change in policy direction, by the time we have a change of government, and that is one, are we going to see a change in policy direction? What is then tied to that as well is credibility. Many people seem to have lost credit. The policy environment now, as it is, seems to have lost some credibility. Even if the CBN governor comes out, or the CBN comes out to say, this is what we are doing and all of that, the market will still go ahead and do what it wants to do, because what people are clamoring for is a total deregulation of that parallel market rate, so that we leave it to the market to determine that rate. So if we don't have some of those changes, I think that there's still going to be a lot of volatility in the parallel market rates, and 800 might not be, I don't think it is impossible as it is. Then on that point,
okay. Sorry, on that point, and I guess this could guide us in terms of the likely outlook. We know that one of the reasons why there is such a huge disparity has been the supply challenges. You mentioned, or rather was praised and mentioned, the issue about the Dangote refinery being and its impact being somewhat muted. But in terms of FX supply, do you think things are going to remain as they are or get worse? Because if they get worse, then I think there's no doubt that rate is going to cross 800. But if they remain as they are, then potentially the authorities can find a way to manage it. What's your view on that?
Okay, so on the supply, so I think that a couple of policies have been rolled out in the last couple of, in the short, not so long ago. And one of them is the RT200 FX program that the CBN, mentioned. But the key issue is, are we seeing the effects yet? I don't think we are seeing the effects yet, and I don't think we are going to see much of the effects in the near term. Particularly, we are speaking to 2023 right now. I don't think we are going to see much of the effects in 2023, which means that we are still going to be seeing, that particular policy is supposed to focus on accretion of FX from the non-oil sector. And if we are not seeing so much impact in 2023, it means that much of our FX reserves position is still going to be hinged on the oil markets, right? Because that's where we currently get the bulk of our FX earnings. And then the next question is, what's our outlook for oil production? I mean, that has been mentioned earlier to be about 1.5 million barrels per day on average in 2023. And the outlook for oil price as well is about 92 naira. I mean, 92 USD per barrel, by the EIA, which is a little lower than what we have in what we had in 2022. And even OPEC itself is, of course, we know that they are trying to manage the supply as well in order to keep prices elevated. So if we are not able to produce up to our potential in terms of oil, and the price of oil is somewhat moderate, and we should not also forget that one of the key issues with supply of oil is also and demand for oil now, also the global outlook for COVID-19. I mean, that's an increasingly important discussion again on the global scene. And I mean, I'm just trying to say that the demand side for oil is also going to affect our own ability to also sell in the global market. And if we are still very much dependent on the oil sector, I don't think that we'll see so much of a change in what we are seeing in our FX position right now. And the 500 million euro bonds that the euro bond maturity that we're also expecting to be an outflow this year, because, like has also been mentioned earlier, we are not likely to see a reissuance to pay that off, which means it's also going to flow out of our FX positions, most likely. So that means that we are even going to see a little bit of decline if we don't see so much. I mean, we have a definite outflow. We are not sure of what's going to be the inflow as it is. So I think where we are right now is where we are going to most likely be.
Okay, I want to go to Nnamdi. And Nnamdi, I want you to also comment on the outlook for the exchange rate. But as you do so, I'm coming back to that Eurobond question, because you did indicate earlier that you do not, you agree with Damilare that you think it's unlikely that Nigeria will roll over that Eurobond. But doesn't it make more sense for Nigeria to do that, given the what's that word now? The outlay in terms of payments at point of rollover. I mean, obviously, you just have to pay a coupon as opposed to redeeming the entire debt.
Yeah. So first of all, if we talk about the Euro bonds, that you're mentioning, that should be the Nigeria 2023, which matures 12th of July, right?
Yes.
It's not exactly, because if you want to roll over, what it means is that they would have to issue
a new one,
Eurobond, right? Mm-hmm. Now, if you look at coupons along the space of most of this Eurobonds, you have ranging from, like I said, even from 6% to roughly about 9%. The market is currently at 11, 12%. If you come out to borrow, that means that Nigeria will have to issue at maybe 12, 12.5, maybe even 13, because people will ask for a premium on top of where secondary market is, which means that they'll be borrowing at 3%, 4%, 5% higher than where they normally would, depending on which of, because I said we have from 6% down to 9%, right? So they were going at maybe about 3% above their peak, which is significant. Why borrow dollars at 12 when you have 37 billion reserves? Why not wait for market conditions to improve and then now look for an opportunity to come in? So what I guess
the reason might be the fact that Nigeria actually needs the FX, and we have a huge budget deficit, no doubt. And then, as you know, we are having FX supply challenges right now. So that could be the rationale.
Yeah, but to solve your FX challenge problem, you really shouldn't take your Eurobond issue and go and sell in the market.
No doubt.
Yeah, so that doesn't
holistic FX supply now.
Yeah, so
we need FX for all kinds of stuff.
That doesn't solve your FX problem, right? Your FX problem to be solved more with how to get long-term or short-term investors to come in. So portfolio managers who are going to come in, long-term funds who are going to come into the country, you want to get remittances from people in diaspora, or you want to export. Those are the areas around which you need to focus on. The Eurobond helps to shore up your reserves, right? Which makes your reserves look good and robust, and maybe help you run long-term projects. So you want to take on long-term projects that can impact on revenue. So eventually you will get those funds back. I mean, if you look at the Ghana case, they were paying school subsidies and rescuing the banking sector and energy sector. They didn't go into things that would generate foreign currencies, right? That will help them pay off on their loans. So if we're going to say, look, we want to borrow, it shouldn't be to help you with your FX liquidity in terms of selling to importers and co. It should focus more on using those funds for long-term projects, which doesn't really solve your problem. So it's more about what happens with the how to get those other inflow sources that I've mentioned to come up. We've seen last year, we saw the official market go from about 430, 440 levels to about 460 levels, right? That's the INE window. I expect that it stays around these levels until after election, but a lot now depends after election of who wins the election and what the person's policy would be, right? We've had different people campaign for different things. We've heard P2B talk about export-oriented economy. Those things don't happen overnight anyways. They're things that take time, right, for it to happen. If you're going to focus on being an export-oriented economy, then having a devalued currency helps. So you might see them decide to devalue to make exporting cheaper, right? We've seen Tinubu talk about removing fuel subsidy and trying to stimulate the economy and go. If those kind of things happen, then you might see foreign investors start to come in, a lot more confidence in Nigeria, which might help the currency strengthen. But one thing is certain, we're way overdue for, I think we're overdue for a devaluation. The spread between parallel market and the official rate is too wide, right? And it will continue to put pressure on the official rate. You have like a 50-60% spread. It will give leeway to rent seeking, continue to put pressure on the official side, make it harder for people to get officially. And you need to find a way to narrow that down. I narrow that down either by increasing rates, which can happen after election. And we should also know that post-election, then, there's a new government, central bank won't be under any political pressure to necessarily keep rates where they are, and will be a bit more willing to, devalue if the need arises, right?
Right.
I think the need is there. One major thing, though, which hasn't been done, and I hope it happens in the near future, is to allow the secondary market trade freely. It's something that we still haven't seen. If we see that happen, then you see the portfolio investors a lot more confident to come in, because we know that for most of these investors, foreign investors, what they need is liquidity. They want to come in and go out. They don't care if market moves, well, not they don't care, but even if market moves 10, 15%, as long as they know they can get in and get out when they want to, then you will see them coming into the country, and that will help your currency. And if they do come in, what we need to do is ensure that those funds that come in are used judiciously in such a way that by the time they want to go out, we don't face pressures, on the way out.
Okay, thank you very much for that. Akinka, I want to come to you now, and if you can speak briefly about the impact of the insurgency on commodity production and raw materials availability. If we're going through the news flow and cycle, it does seem like things are better than they were perhaps 12 months ago, but what's your assessment of the insurgency on agriculture in generally?
I think the insurgency in agriculture is real, and it's something that the government needs to keep a tab on to ensure that the lingering effect is fully mitigated. Yes, it's real, but it's mostly muted in some regions, and then it's also much more predominant when you look at the logistics factor of moving goods from one place to the other, right? So if you're following the news recently, you discovered that goods in transit are at a higher risk these days due to some of these insurgency activities. On core agriculture production activities, right, we see a lot of insurgents acts in some regions. But if you look at the impact as a whole compared with the agricultural ecosystem, I still think we are not yet at that point where it would disrupt the whole economy as a whole. Like I mentioned earlier, the agricultural economy, the agricultural to GDP, 24% of GDP is huge, with grain production at 3% of it, right, of our GDP. Now, if you look at that area, that's a huge value that is in the market at that point. Now, is it likely that the Insurgents Act and whatever it is that they're perpetrating will completely eradicate this or put this value at risk? I don't think so. The fact I'm more concerned around is that we need to increase productivity at that level. Agriculture is critical to our economy. 24% at 40% efficiency has potential to be increased greatly. What are the structures we could put in place as a nation to ensure that access to production materials, raw materials for production, fertilizer, urea, is more streamlined, and then transporting them from where they are produced to where they are consumed is very, very key. So just to speak to your point again, right? If you look at the northeastern part of the country, there's a ban on movement of some key kind of inputs to that region, because those kind of inputs could be used as explosives or whatever by insurgent guys. Now, what the impact of that is, production in that area is fully closed down, or if it's not closed down, it's really working at 10-20% of the potential that we have there. The government needs to put in more structure to ensure that those areas could be further developed. And the way they can do that is, I think, to the best of what they are doing right now, tackling it head on. And like you rightly said, it's gone down. But we hope that post-election and whoever comes in, there's a definite stance against it, and then hopefully this nightmare goes away from us. But on a broader level, we see more activities in other parts of the country. On a higher macro level, we also see increased investments in this ecosystem, meaning that more people are seeing more potential in agriculture, especially on infrastructure, right? Building warehouses, leveraging on technology for logistics, moving goods up and down across the country. More investments are coming here. Do we have the capacity to take in more? Yes. This is one of the greenest fields we can ever imagine in the country as of now. And the more we put a much more transparent path for foreign investors to have a definite path to invest in this economy and then seamlessly take out their cash when they are ready to go out, the more we see more participation in this ecosystem, and then we build the capacity here. And I keep saying, the capital market cannot be left out of this. There are innovative products that the market could leverage on to build capacity in this place and then increase the return that they expect to get on this. We've seen a lot of products being developed that addresses some of these needs in the market. We see a lot of asset-backed commercial papers being issued there that leverages on the structure of warehouse integrity, quality and quantity guarantee that ensures that your assets, your capital is not lost when you invest in this ecosystem. Yes, people had bad experiences in the past when they invested in ag, yes, but I think that regime is gone, and then we see a lot more regulatory involvement in this, and then a much more capital-focused product development activities that seeks to encourage capital that are required to grow this market, whilst ensuring that investors have capacity to grow return on their portfolios as well.
All right. Well, thank you so much, Akinka. I think this has been a very valuable interaction. I want to thank all our speakers for their presentations and for their comments and responses to questions. I think that's been valuable. I think many major takeaways, obviously a lot of uncertainty in the horizon, but hopefully the information that we have shared today will be useful in navigating what is a very uncertain 2023. On that note, I want to now welcome, or should I say invite, to deliver some closing remarks, the Managing Director of Meristem Finance, Mr. Mubo Olasoko.
Okay, so it's a Mrs.
My apologies. I meant to say Mrs.
All right, thank you, Wale.
My apologies. Please go ahead.
Okay, so thank you very much, everyone, for your attendance at our webinar of today. It's been quite inspiring, to see so many people wanting to know which way to go in the year 2023. At the peak of this webinar, we're about 358, on the call, which is quite inspiring. And I also note that we're not all participants from Lagos. Various people joined from various locations. We had people from Benin City, Ile-Ife in Osun State, the United Kingdom, Lagos, Abuja, the United States of America, Agbo in Delta State, Kebbi State, Nasarawa State, Accra, Ghana, Kano, Maiduguri in Borno State. I wish you can just, clap for ourselves, for this feat, that was achieved today. We want to thank you very much for coming. We looked at a very important topic, dark clouds on the horizon, any silver lining. As has been said, looks like there are so many uncertainties, but of course, through it, we can also see some silver lining that we can take advantage of and exploit, to our advantage. And I want to say that we should look at this silver lining, take advantage of them, so that we can be successful at all that we do, even in this year, 2023. I know that we have different takeaways, different perspectives, from today. And I know that Meristem, is a capital market conglomerate. And we provide services, that can help you in making decisions about your investments, in helping you with financial advisory. Maybe you have companies, financial advisory, you don't know which way to go. We also have wealth management services and various other services that are offered in the capital market. So should you need any support, for this year, Meristem is there and available, to handhold you and to help you through this process in the year. We really wish you the very best in the year 2023. And maybe sometime during the year, when we call again, to assess how far we've gone, we know that you'll be willing, to attend and also to share ideas with us on how this has helped you through the year. So thank you very much, everyone, for coming. We wish you a fulfilled day. Thank you very much.
Thank you very much, Mobo, for that. And thank you again to everyone for jumping in on this call to get some perspective on the outlook for 2023. I'd just like to say that if your questions have not been answered, I have appealed to our speakers to type in responses before we close out. So you can just hold on for that. But to everybody else, I'd like to say thank you so much for joining us. And we look forward to having you at the next event. Enjoy the rest of the day.
Why should your wealth end with you? Let your story continue.
Meristem, let's grow wealth for you.
The stars, now let's see you conquer galaxies. You've gone for gold. Let's show you 2 more treasure chests.
Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation. And the generation after that.
Don't stop.
After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue.
Meristem, let's grow wealth for you.
You've reached the stars, now let's see you conquer galaxies. You've gone for gold. Let's show you 2 more treasure chests.
Your story doesn't have to end with you. As a matter of fact, it can continue into the next generation. And the generation after that.
Don't stop.
After all, you've worked hard to get to where you are. Why should your wealth end with you? Let your story continue.
Let's take you.
Menace Ham, let's grow wealth for you.